Alright, so far I've been running through individual stocks of companies that came into my radar, so this video is for those of you who have no interest or no time to dabble in the stock market. Either the idea of reading about businesses and the economy just makes you sick. Yeah, I can understand that because it's just not aligned to your interest. Or perhaps you are keen on the stock market, but you are just so busy with your career or business, you just don't have the time to do the research. I think these are perfectly valid reasons, but one thing for sure is that you know the advantage of the stock market and you want to take advantage of it despite having no interest or no time. So here is a simple proposal, and that will be to invest in the S&P 500 index funds. So what is this exactly? Well, first you need to understand what this S&P 500 index is. This Standard & Poor's 500 index is a market capitalization weighted measurement of 500 of the largest publicly traded companies listed in the United States. It is one of the most popular indices and one that many consider as the best overall measurement of the American stock market performance. But since companies vary in different sizes, the S&P 500 index will give more weight to companies of larger market capitalization, so on and so forth. For the benefit of everyone, market capitalization, or in short what we call market cap, is the sum value of all the shares or stocks a company has issued. In short, to calculate the market cap of a company, simply multiply the number of shares issued by the current share price. Anyway, as I was saying, the S&P 500 index is a market cap weighted measurement. This means that a company whose market cap is say $50 billion will receive 5 times the representation in the index compared to another company which is worth $10 billion of market cap. This will then be more representative of the market movement compared to giving the same weightage to each of the 500 companies in the index. Now that this is clear, let me give you some information about how these 500 companies are selected. First, understand that a committee will be the one picking these corporations based on their liquidity, size, and industry. As a matter of fact, the index rebalances itself every quarter, say in March, June, September, and December. In order to be included in the index, a company must meet the following criteria. It must be formed in the United States, it must have at least an unadjusted market cap of $8.2 billion, it must have at least 50% of its stocks made available to the public, its share price must be valued at least $1 per share, at least 50% of its revenue and fixed assets must be in the US, and finally, other than reporting the annual report, also known as 10K, it must have at least 4 consecutive quarters of positive earnings or profit. The reason for sharing with you all these criteria is so that you can better appreciate these companies are of substantial sizes, they have sufficient liquidity so that you can buy and sell their shares readily in the market, and that they are making profits. And of course, by definition, their key businesses got to be in the US. So these are the top 10 companies with the highest weightage in the S&P 500 index, and they are very familiar names like Apple, Amazon, Microsoft, so on and so forth. In fact, the concentration of the index is well spread out across various industries ranging from information technology to financials and the energy sectors. Now that you have a better overview of this S&P 500 index, understand that you can't buy into this index directly per se. But there's a number of funds that track this index that you can buy into, and they are very similar to how you buy and sell your stocks in the market using your brokerage account. The two common ones are the SPDR S&P 500 Trust ETF and the Vanguard S&P 500 ETF. I pointed out these funds because that's what Warren Buffett's investment holding company Berkshire Hathaway is holding currently as well. There's not much difference between these funds as they practically track the S&P 500 index very closely. We are not going to do a deep dive on the differences between these index funds since our objective here is to get you invested as soon as possible, and really they don't differ much. But for now, let's pick Vanguard for our discussion as it has a lower expense ratio of 0.03% compared to SPDR, which stands at around 0.09%. Expense ratio is the percentage the fund charges for administrative, advertising, and other related expenses to manage the fund. Hence, in this case, we will go for the one with a lower expense ratio, assuming that our strategy here is to hold for the long term. So a lower expense ratio will benefit your return in the long haul. Before we discuss further, let me clarify here that S&P 500 is not the only index out there, nor is it the only index that funds track. There are many others like Dow Jones Industrial Average and the Nasdaq. The key difference lies in what their focus are. For example, the Nasdaq tends to have more than 50% of its portfolio in the information technologies sector, whereas the S&P 500 has less than 30% of its portfolio in tech-related stocks. And again, here we just want to get you started to gain exposure to the stock market, so let's stick to the Vanguard S&P 500 ETF for now. Let's take a look at the past performance of this index fund. Notice that if you had invested in this fund 10 years ago, it would have given you an annual return of 13.87%. That's a pretty decent return given the very passive investment approach, and observe that this is very much similar to the S&P 500 index return itself, which generated 13.91% per annum over the last 10 years. The difference between the index and the ETF is really small, as you can see. In actual dollars terms, say if you had invested $10,000 10 years ago, today it would be standing at just slightly less than $40,000. That's the power of the compounding effect over a long period of time. Just a side note, the past 1 year return is exceptionally high as you can see here due to the major market correction back in March 2020 during which the initial outbreak of the coronavirus pandemic occurred. The subsequent recovery and the strong bull run of the market is why we see the figure for the past 1 year return is more than 50%. That aside, an average return of more than 10% over the long term plus a 1.3% dividend yield seems a pretty good return to me for a very passive investment strategy that you don't have to research which companies to buy into, etc. But I must say here that the past performance does not translate to future performance. Buying into such fund is a bet on the US economy, so of course there's associated risks such as interest rate, currency, and regulatory risks just to name some. Also, the market may be overvalued from time to time, so one way to overcome this is through dollar cost averaging. You can buy into the index fund at regular time periods, say in the middle of every month, so that you can lower your average cost if the market trends lower. And because of the regular buying into the fund, you don't have to fear missing out on the bull market if it climbs higher. Make it like a regular savings plan. But of course, if you have the chance to buy on a dip, like the significant correction back in March 2020, then go ahead. Therefore, to sum it up, I would say that investors who are not interested or have no time to dabble with the stock market but still want to take advantage of it should really consider investing in the S&P 500 index funds and hold for the long term. In fact, Buffett has been a strong advocate for the S&P 500 index funds all these years, saying that most investors would be better off investing in index funds than picking individual stocks on their own. So I hope today's sharing has been helpful. Remember to subscribe to the channel and click on the notification bell to get notified once our next video is out. In the meantime, check out the recommended videos here if you find it helpful, and I will see you soon.